Hello dear learners, I am Dr. D.V. Singh from Department of Commerce, the Bhopal School of Social Sciences. Today in this module, I am going to discuss about set off and carry forward of losses under Income Tax Act 1961. So let us start with what is set off. Set off means it's an adjustment of losses against the eligible profit of the year. It is governed by Section 70 and Section 71 of the Income Tax Act. There are basically two types of set off. Number one, inter-source adjustment. Number two, InterHead Adjustment. So let us discuss about inter-source adjustment. Inter-source adjustment, basically it's a setting of loss of one source against income from other source within the same head. For example, suppose an assessee is just getting loss from one self-occupied property, so that loss can be set off against income from let out property. Same way, if assessee is getting loss from one business, say for example loss from textile business, that can be set off against profit of leather business also. Now just by practical example you can see and try to understand. Suppose Mr. X has two businesses, A and B, and from business A Mr. X has earned the profit of rupees 5 lakh, but because of some bad situation or some other reason, the business B suffered loss of rupees 2 lakh. So these 2 lakh loss can be adjusted with the profit from business A. This way we can say that the taxable income from business is rupees 3 lakh. Now 2 lakh loss would be adjusted, but there are certain exceptions to this rule. Means there are certain losses which cannot be adjusted or which cannot be set off inter-source under the same head. For example, like loss from speculation business, loss from activity of owning and maintaining race horses, set off of losses against casual winnings, long-term capital loss, loss from an exempt source of income, and loss from business specified under Section 35 AD. Now move to another Section 71, that is Inter-Head Adjustment. Under this section, loss can be set off against income under other head. For example, suppose loss from non-speculative business can be set off against house property or any other business income. Now again there are certain exceptions to this rule also, like loss from speculation business cannot be set off against income from other sources or income from house property or income from non-speculative business. Same way, there are certain losses which cannot be adjusted inter-head incomes. Again, for example, loss under the head profit and gains of business or profession against the income from salary, loss from activity of owning and maintenance of horse races, set off of losses against casual winnings, or any loss under capital gains. Now let us summarize the entire set of rule. Loss from house property can be set off against income from salary, income from business, income from capital gains, and income from other sources, while loss from speculation business can be set off only against income from speculation business, while loss from non-speculation business can be set off against house property, capital gains, and income from other sources. Here always remember that the loss from non-speculation business cannot be set off against the head salary. Then long-term capital loss. Long-term capital loss can be set off against long-term capital gains only, while short-term capital loss can be set off against long-term capital gains as well as short-term capital gains, while loss from other sources can be set off against any heads of income like salary income, house property income, business income and capital gains. So as per the Income Tax Act, the provisions which are given to set off and carry forward of losses, suppose an assessee who is continuously suffering the loss in any particular assessment year, so he has given some provisions under this act that either he may set off his losses, or if it is not possible to set off, he may carry forward to be set off in near future. So losses which could not be set off against income of the assessment year and do not lapse but are allowed to be carried forward to be set off against income of subsequent year. Carry forward of losses for each head is governed by different section which define the numbers of years it can be carried forward for, against which income it can be set off. So before starting the losses which cannot be set off by same head, or once suppose it's carried forward, so how long we can just carry forward these? So I am just going to discuss on that. For example, suppose house property loss. So once loss from house property just carried forward, it can be set off only against the head of income from house property. In previous slide, I told you the loss from house property in the same year can be set off by other heads also. But once it's carried forward to next year, it cannot be set off by any other heads of income. And this loss can be carried forward maximum up to 8 assessment year. The time period is to be calculated from end of the relevant assessment year in which loss was occurred. For example, if loss related to assessment year 2012 and 13, so this loss can be carried forward up to the assessment year 2020-21. Now next, it's related with the business loss, or you can say non-speculation business loss. Non-speculation business loss can be set off against any other heads of income except salary in the same year, but once it's carried forward to be set off in near future, it can be set off only against income from non-speculating business or income from business. It can be also carried forward up to maximum of 8 years. It is not necessary that it must be set off against income from same business. Such loss can be carried forward only if the return of income of the year in which loss is incurred is furnished on or before the due date of furnishing the return as prescribed under section 139(1). Next, capital loss. As I said, capital loss can be divided into two parts: short-term capital loss as well as long-term capital loss. Short-term capital loss can be set off against short-term capital gain as well as long-term capital gain. But long-term capital loss can be set off against only long-term capital gain in the same year, as well as once it's carried forward to be set off in next year, that can be set off against long-term capital gains only. The maximum time period to be carried forward, maximum time period for carrying forward this loss is 8 years. Such loss can be carried forward only if the return of income tax of the year in which loss is incurred is furnished on or before due date as prescribed under section 139(1). There are certain exceptions of this rule also. Now move to next, loss in speculation business. Here, loss in speculation business can be set off only against speculation profit in the same assessment year. Once it's carried forward to be set off in next year, it can be set off only against the speculation business profits. It cannot be set off against any other head. The business to which the loss pertained to may be discontinued. this loss can be carried forward up to the period of 4 assessment year. Such loss can be carried forward only if the return of income of the year in which loss is incurred is furnished on or before the due date. Now, loss of specified business under section 73A. Any loss computed in respect of a specified business shall be allowed to be adjusted only against profit of some other specified business. If any loss remains unabsorbed as above, it can be carried forward and it is to be set off against only income of the specified business profit only. There is no as such time limit for such losses. Next one, loss of activity of owning and maintaining race horses. Again, such loss can be carried forward if not adjusted in the same year in which the such loss is occurred. It can be carried forward up to maximum of 4 assessment year, and in future it can be set off with the profit of activity of owning and maintaining race horses only. Then at last, unabsorbed depreciation. Unabsorbed depreciation will be first set off against profit of any other business or profession, if any, or it can be set off against income of other heads except salary and casual winnings. Once it is carried forward, it can be set off against any other head but except salary and casual winnings. There is no time limit for adjustment of such losses. It can be set off even the business to which unabsorbed depreciation pertains to has been discontinued. Now let's start and try to understand what is clubbing of income. Clubbing of income means income of other persons included in assessee's total income under some special circumstances. For example, transfer of income without transfer of assets under section 60. Second, revocable transfer of assets under section 61. Then transfer irrevocable for a specified period under section 62. Income to spouse from a concern in which such individual has substantial interest under section 64. Income of a minor child under section 64(1)(a). Transfer of income to son's wife without adequate consideration under section 64(1), and income from converted property under section 64(2). So, my dear friend, I would like to mention here, these are the incomes which is related with other person, but because the assessee is just trying to maybe hide or maybe some other reasons without informing the assessing officer, if doing so or just transferring these income before the due date without any verification or specific reason, then these incomes would be clubbed with the income of the assessee. Then there are certain deemed incomes under section 68 to 69D. Number 1, it's a cash credit under section 68. Unexplained investment of the assessee for which assessee is failed to give any justification, that is also considered as a deemed income of that assessee under section 69. Unexplained money under section 69A. For example, suppose your bank account is showing some amount which is for which you are unable to give proper justification or proper accounting record, that will be also considered as a deemed income of that particular assessee. Next, undervalued investment or valuables. Suppose you are just showing your investment at low price or any valuable thing showing at low price, so that is also considered as a deemed income of that assessee under section 69B. Then unexplained expenditure under section 69C, and finally amount borrowed and repaid on hundi under section 69D. So if any assessee in the previous year failed to give the proper justification of these information, so all these heads are considered as a deemed income of that assessee, and that assessee is liable to pay tax on these incomes. So my dear friend, this is the end of this module. I will come back again with another topic. Thank you.